Hi, I'm John Inslee, president of J. Inslee Financial LLC, and I'm one of just a handful of Bank on Yourself authorized advisors in North America. Today's tutorial, we're going to talk about Bank on Yourself real estate investing strategies. We get lots of questions about this from clients, so I thought I'd put together a quick tutorial on exactly how you can use a Bank on Yourself designed whole life insurance policy to invest in real estate. We're going to show you how to cut out banks, mortgage, and finance companies and become your own source of financing for real estate investing. So who can benefit from doing this? Pretty much anyone involved in the real estate investment business. Wholesalers, flippers, rehabbers, buy and hold, landlord type scenarios, lien holders, hard money lenders, syndicators, fund managers, commercial developers, and residential developers. And then, of course, even dabblers could benefit from using these strategies. In my view, no financial vehicle works better for real estate than a modernized, specially structured, dividend-paying whole life insurance policy like we've been discussing throughout these tutorials. With Bank on Yourself, there's no credit checks or lengthy paperwork. You have access to your cash in very short amount of time. There are no fees or gotchas to get your money. And you make any monthly payment you want or none at all. You are in complete control of the situation. Life insurance policies are private, unilateral contracts. The insurance company can't change the rules without your consent because they have a contract in place with you. The government doesn't put limits on how much you can put into the policy. There are no penalties or early withdrawals or any of that mumbo jumbo. There are no required minimum distributions, and you can use policy loans to access your money for any purpose you want. There are no prohibited transactions and just none of the red tape that's typically associated with real estate financing. This is Nelson Nash. Nelson, back in the 80s, found himself in some real estate investments where he was leveraged, and when interest rates went crazy, he actually, fortunately, had been contributing to dividend-paying whole life insurance policies for quite some time and was able to borrow against his policies to turn that very difficult, challenging situation into a profitable situation. Nelson says, when you can control the financial environment, you win. When the bank controls the financial environment, they win. And really, that's what the Bank on Yourself approach is all about, maintaining control of your own financial environment for your own benefit. So exactly how do we do it? It's really 4 simple steps. We use the equity in a dividend-paying cash value whole life insurance policy to purchase real estate. Now remember, one of the key features is that when we borrow from our policies, our money continues to grow in the policy as if we didn't borrow it. So that means your equity or your capital continues to grow even though you've borrowed it to make a real estate investment. You control the repayment schedule. You can pay it back as much or as little as you want or not pay it back at all for a while. You own the policy. You're in control. And then when you sell the property, you can then put that money back into the policy and essentially recycle it for the next investment. If you recall from one of the earlier tutorials, we talked about the biggest misconception. And that is, it's Bank on Yourself or these whole life insurance contracts versus all these other things that we might do with our money. But in reality, it's not an either-or scenario. It's Bank on Yourself and some of these other things, and in particular, real estate. So exactly how does it work? We as an individual policy owner own a whole life insurance policy with cash values. We access a policy loan. We then deploy that borrowed capital into a real estate investment. Now that investment will produce cash flow, whether in the form of rents coming from payments, or if you're a flipper or something like that, then that cash flow may be in the form of increased equity that you could then sell and pull that cash back out. In either case, that cash flows back to the policy owner, who then uses the cash or a portion of the cash to repay the policy loan. Now, because of non-direct recognition loans on our policy, we know that even though we've borrowed that money to use to make this investment, it's going to continue to grow. So we're going to accumulate policy equity at the same time. We're also going to have an increase, hopefully, in the equity of the investment that we've made. And so essentially, by using the Bank on Yourself policy, we get both the equity in the policy and the increased equity and cash flow in the investment. This is why we say you can never do as well using money outside the policy as you can flowing through the policy. It should be part of a well-diversified plan. Real estate investing and Bank on Yourself is not an either-or. It's a both-and scenario, because when you combine them together, they catalyze the power of each, kind of like nitro and glycerin. Greg and Christy Gammon are flippers. They flip properties with leverage from Bank on Yourself policies. They pay themselves back with profits from the flip, and the policies continue growing and accumulating equity while they're waiting for the property to sell. So even though we've had some policy loans out, we continue to get the same guaranteed annual cash value increases, and we've got dividends every year too. They also say the nice thing that we're starting to realize is that we're not beholden to an institution, they're talking about banks, to give us the financial backing that we would need to help our business grow. So let's get into the actual strategies. Strategy number one is the simplest strategy, and it's cost arbitrage. So we use the equity in our Bank on Yourself policies to pay for things like property taxes, homeowners insurance, HOA specials, repairs, maintenance, etc., etc. And essentially, it gives us the ability to flow these costs through the policy so that we get a positive arbitrage on those costs. In other words, if we were just paying those costs with cash out of pocket, we'd be giving up the growth we could have earned on that cash had we put it into the policy. Strategy number two makes logical sense, extending out the first strategy, and that is we make down payments using the policy. So we remove the need for mortgage insurance because we can make a large enough down payment. We could also have our corporation own the property and actually rent it out back to us and create some tax advantages and mitigate our opportunity costs on those down payment dollars. The third strategy is a further extension of the first two, and that is we borrow from the policy and pay cash at closing. This allows us to increase our yield on the investment without taking any risk of the money, and at the same time developing a permanent line of credit that's ready for the next recession, the next opportunity. Let's look at how this works in an actual policy. Watch the dividend column carefully. You can see what the dividends are in years 11 through 15. Now here in year 11, we add a $350,000 policy loan that we use to purchase real estate. Note that even though we took the loan out, we have the same dividend crediting as we had without the loan. This is the power of non-direct recognition. So now we pay that loan back on whatever term we want to. We showed it paid back over 5 years in this particular scenario. And note that the cash value and the death benefit after the loan is paid is exactly the same as it would have been whether we took the loan out or not. This keeps us in perfect control of the financial environment. So if we compare the appreciation of the property, the loan interest we would pay, the policy's growth, the return on investment, and total growth. If you pay cash and you don't use the policy, you have the appreciations, whatever it is. Of course, you would not pay policy loan interest, and you would not also get any policy growth. Your ROI would be about 3% in this scenario, and you would pocket about $55,000 in profit. If you use your Bank on Yourself policy, you get the same appreciation. You pay a couple of points in loan interest, but look at this. The policy grows $119,000 in the meantime. That gives you an ROI of 10% and profit in your pocket of $175,230. So the question is, which would you rather have? An ROI of 3% and $55,000 in your pocket, or an ROI of 10% and $175,000 in your pocket? Kind of a no-brainer, right? Strategy number 4 is what we call equity harvesting. And so there's two ways to do this. We could flip the first property and use the profits to fund the Bank on Yourself designed whole life policy, or you could actually do cash out refinancing on existing properties and harvest that equity to get them started. With home values at record highs right now, what better time to do this than now? Here's how it would work. Let's say we own 4 properties, each at $100,000 in value. They appreciate at 3% per year. That's about $12,000 per year in appreciation. Every 5 years, we would do a cash out refinance, pull $60,000 of that equity. We would harvest it, in other words, and drive those funds into the Bank on Yourself designed whole life policy, essentially locking in the real estate gains in a policy. This is something that's often misunderstood. By separating the equity from the property and holding it in a safe place, such as a whole life insurance policy, we essentially lock in our gains. Even if the market value declines, we've already separated our cash out and put it someplace where it'll continue to grow. As a bonus, you could then borrow against that increased equity in your policy to purchase another property. By the 5th year, look at what happens. The total property appreciation is about $510,000. Plus, the policy's growth continues on even on the capital that we've borrowed. So our total annualized appreciation is about $17,875, as opposed to just the $12,000 that we were getting in appreciation without the policy. So again, which would you rather have? Almost $18,000 a year in appreciation on the properties you own, or just $12,000? Again, kind of a no-brainer. So what we've done is just increased our cash-on-cash return with absolutely zero market risk. Strategy number 5 is the rental repayment strategy. And essentially, we're going to use the policy to purchase property that we then rent out. We hold that property and rent it. The tenants essentially are paying off our policy loans for us. The policy continues to grow, and we don't lose any cash flow to make other investments in the meantime. So you can see how this plays out. If we borrowed $120,000 to purchase the property, we rent the property out. We have rents coming in that then form the loan payments, and you can see the cash values and death benefits that continue to increase. At the end of the day, after 10 years of doing this, we have $284,000, which is the net cash value plus the original loan returned to us, and our tenants paid all of that. Plus, this is all backed up and guaranteed by a $355,000 death benefit. It's a winning solution all the way around. Strategy number 6 is other people's money. Let's say you have a project and you need outside capital investment. What you would propose is that each outside investor opens a policy, borrows from the policy to invest in this project that you have. All the investors would mitigate their opportunity costs, and if they understand the strategy, they're going to be very willing to work with you. And essentially, the profits from your venture would then fund an additional policy or continuing to fund your existing policies as you continually increase this warehouse of wealth that you're building. Then, of course, the ultimate strategy is why bother with the nuisances of owning real estate and just be the banker. Use a massive portfolio of policies. Serve as a private money lender. You could hire third-party underwriters and risk assessors. Forget about fixing leaky roofs or tenants who don't pay their rent, and just collect everyone's mortgage payments. Imagine what you could do. Think back to 2007, 2008. When nobody could get money from banks because credit was so tight due to the real estate and stock market crash and the financial crisis. Imagine if you had ready access to capital during that time period in a tax-favored environment, and when the next real estate market correction comes, what could you do? This brings us to Tim's story. Tim was presented a rental property investment opportunity in 2005, and it continued on through the Great Recession period in 2007 through 2009. The banks were severely limiting financing to 4 properties for an investor, but Tim had liquid dollars in one of his policies. So he formed a property management company with his brother. He loaned money to the company, charged 10% interest with the loans paid back in 4 years, and made lots of profits. Tim says, "My brother and I opened the property management company 50-50. I loaned the money to the management company at 10% over 4 years. My brother was happy to pay the 10% because he couldn't get the money for less or couldn't get the money at all. And once the loans were paid off, we owned the equity 50-50. And this is a key point that Tim made. If I had just given him the money and didn't have him pay me back, I would have given up the 10% principal. the 10% and the principal, I would have just owned 50% of the value of the property management company. In other words, what Tim is saying is there's no way he could have done as well not using his policy as he did using his policy. He and his brother did this over and over and over again over the last 22 years and have purchased so far 22 properties. Tim commented that wealthy people save different than poor people. They understand the cycle of real estate, and most importantly, they understand the importance of having a massive pool of contingency capital to take advantage of the opportunities in the next crisis. This comes up over and over and over again, all the way back to the Great Depression. Having a massive pool of contingency capital to take advantage of the opportunities that arise during a crisis. There is no better place to accumulate a massive pool of contingency capital than in a properly structured whole life insurance contract. How did this work out for Tim? His original policy had a death benefit of $822,000 with cash values of about $236,000. Over the 10 years, the equity in their real estate accumulated up to $722,000, a little over that. Plus, Tim took out a new policy on the life of his brother. If you have business partners, this is something you should absolutely do. And they continued to take the cash flow from the properties and fund that policy. And that policy now has cash values of $176,000. What does all this mean? Tim's original $196,000 in premium today is backed up by a death benefit of $1.459 million. Their total net worth between the equity in the policies and the equity in the real estate is $1.135 million. If you do the math, Tim grew his money. The total premiums $196,622. Now with a net worth of $1.135 million, that's 477% gain over 10 years. You should also note that 36%, more than a third of that net worth figure, is coming purely from the equity in the whole life policies. Further, Tim says, if I didn't start the policy in 1996, could I have taken advantage of this situation? No. Could I have done this with a 401k? No. Now, could I move my IRA into real estate? Yeah. Is it a pain in the butt? Yes. Is the policy much easier? Could you do this strategy with stock or classic cars rather than real estate? Yeah. Oh, and by the way, Tim spends about 2 hours per year on this investment. So there you have it. Bank on Yourself real estate investing strategies. Cost arbitrage, down payment, full purchase, equity harvesting, rental repayment, other people's money, and ultimately be the bank. Thank you so much for your time and attention. I truly appreciate it, and I'll see you on the next video.